Good afternoon and welcome to ICG Enterprise Trust's 2023 Investor Day, the first such day we have ever hosted, and we're very glad you can join us in person and also a large number of people online. There will be time for Q&A at the end, and to remind those online, you can submit questions through the portal at any point. For those of you joining us in person, we'll hope you join us for a drink afterwards. During the next couple of hours, we hope to give you a greater insight into ICG Enterprise Trust, why we invest where we do, and how we construct our portfolio in the way that we do. Unpacking what our return profile looks like in more granularity than you'll have seen before, and digging more into how we assess our outcomes as a trust, both in terms of the NAV returns and the shareholder experience. Indeed, we are covering an awful lot today, but there are 4 key messages we want to leave you with. ICG Enterprise Trust has a clear investment strategy focused on delivering defensive growth over the long term. To achieve this, we have an actively managed, differentiated portfolio of private equity-owned companies in the US and in Europe. To source, execute, and manage these investments, we have a dedicated team based in London and New York who benefit from access to our manager, ICG's deal flow, as well as having deep relationships with a global group of leading private equity managers. And finally, we take a disciplined approach to capital allocation, reinvesting, dividends, and buybacks. To dig into these topics in more detail, I'm delighted we have a range of speakers today. We have Jane Tufnell, your chair, the 3 members of ICG Enterprise Trust Investment Committee, Oliver Gardy, Colin Walsh, and Lisa Lee Marshall, 2 managers of funds that ICG Enterprise Trust invests in, Steve Klinsky, the founder and CEO of New Mountain Capital, one of our US relationships, and David Lomer, a senior member of ICG's European corporate team, a member of the investment committee and the head of UK, Benelux and the Nordics. And we will also be joined remotely by Nick Brooks, ICG's chief economist. We're going to start quite broad, macroeconomic perspectives and the implications for private markets, and then narrow down to private equity, ICG Enterprise Trust specifically, and then concluding, as I said, with how we assess our outcomes. But before that, I would like to pass over to your chair, Jane Tufnell, for some introductory remarks. Jane.
Thank you very much, Chris. And thank you all for coming to join us this afternoon. I think this trust has come to offer a very long-term role as a core holding within your client's portfolio. I think it's differentiated in that we aspire to create an all-weather portfolio, an all-weather private equity portfolio that will plod consistently forward. And by doing that, we'll enable your clients to enjoy the low volatility and thus enjoy the long-term compounding effects of these very attractive IRRs. So all aspects of the structure of this portfolio reflects that aspiration of being a plodder. We focus on buyouts rather than venture growth. We focus on the deepest private equity markets in North America and Europe. And increasingly, we now have the balance between primary, secondary, and directs. Another thing about this trust, which is unique, is we're the only listed vehicle with access to ICG managed investments, and 30% of the portfolio is currently in ICG managed investments. David Lomer will be speaking to that part later. We have an excellent board, which is very proactive on behalf of shareholders. Some time ago, we adopted a progressive dividend policy. Since October last year, we've enacted a long-term buyout policy. And we remain very focused on long-term capital appreciation for shareholders alongside progressive income. And this last year, we've been working hard with the manager on the costs of this fund. We've agreed a new fee structure and a cost-sharing arrangement, which will, to some extent, cap the costs as the fund continues to grow. So we've been busy on shareholders' behalf, and the manager likewise. The trust moved from Graphite, UK equity-focused house, to ICG, international debt and equity products, in 2016. And in 2019, ICG recruited Oliver Gardy and appointed him the lead fund manager on this trust. See, ICG have consistently invested heavily in a dedicated investment team for this vehicle, which sets us apart from our peer competitors and is proving an enduring, increasing differentiator. The differentiation is still coming through in performance. The last 5 years, invested with us generated 16.9% annualized returns, and the last 3 years, 20% plus, which is net of all fees and costs. So I believe that we've got to an interesting place. Performance continues to be good. Our concentration on defensive growth and avoidance of venture has begun to differentiate us, and we're beginning to show the market more of what we are on that basis. The new management team, with the arrival of Oliver in 2019, has now bedded in, and we're reaping the benefits. Particularly, you see that on the secondary side. Costs have been revised and agreed. We've got the dividend buyout approach that Chris referred to that's positive for shareholders. So a lot's been going on. So thank you for coming today and to hear what we have to say, and I hope that and expect it to be worthwhile. Thank you. We've now got Nick Brooks on video for the economy.
Hi, it's a pleasure to be able to speak to you today. Over the next few minutes or so, I'd like to set the scene by giving you a big picture view of how we see the macro environment evolving, how that may affect the investment outlook, and in particular what that might mean for private market investors. Over the past few years, we've seen truly dramatic changes. We've lived through the worst pandemic since 1918. We've had to manage an energy price shock driven by Russia's invasion of Ukraine. We've experienced the fastest increase in inflation since the 1980s, and the sharpest rise in interest rates in over 40 years. Despite these difficulties, human ingenuity, strong policy responses, and some luck has allowed life to largely return to normal. Most economies have now recovered to pre-COVID levels, and most companies and markets have more than made up losses during COVID. The question, of course, is where do we go from here? I think there's little question that the sharp rise in interest rates over the past 18 months and the hit to disposable incomes from the rise in inflation are still feeding through the system. Generally, monetary policy works with a lag. And during this cycle, I think the lag has been longer than usual because of the substantial savings built up during COVID. However, as those savings dwindle over the coming quarters, the impact is likely to become much more apparent. Private consumption and investment are likely to slow, particularly in more cyclical and interest rate sensitive sectors. Ultimately, this should take pressure off wages and inflation and allow interest rates to fall again. But in the meantime, investors will likely have to contend with slower growth, sticky core inflation, and interest rates that have to stay higher for longer. So what does that mean for the investment environment? I would argue that the most critical immediate question for investors is how severe the slowdown will be and what that might mean for company earnings and broader company fundamentals. In our view, for most countries, the slowdowns will be relatively moderate when compared to the deep downturns experienced during the 2008 global financial crisis. The critical difference between the 2008 crisis and the situation today is the strength of the global banking system. Looking at data back to the 1920s, deep recessions have always been accompanied by systemic financial crises. And given the crucial role banks have historically played in creating credit, this shouldn't come as a surprise. While U.S. regional banks are facing difficulties, their problems have been largely contained to the sector. Most critically, the world's global systemically important banks remain in good shape. Balance sheets are strong, with the Tier 1 capital ratios of European and UK banks more than double 2008 levels. Liquidity buffers are large, and banks are now stress tested by regulators on a regular basis. This makes the risk of a systemic global financial crisis very low in our view. If this is correct, then the economic slowdown ahead is likely to be much more moderate and much more sector-specific than the deep and broad-based recessions experienced during the 2008 global financial crisis. While some countries may see some quarters of negative growth, unless we experience another large external shock, deep across-the-board recessions are unlikely in our view. As you can see in this slide, consensus forecasts are for quite moderate slowdowns across major developed economies. IMF and most central bank forecasts are very similar. While the downturns may ultimately prove to be somewhat deeper and longer than these forecasts, we think that similar to what we saw during the COVID period, a key feature of the slowdowns is that there will likely be wide performance dispersion at a sector level. This should play to the strengths of investors that have long-term investment horizons and strong bottom-up analytical capabilities. So where do we see the biggest risks and opportunities? The most vulnerable sectors in our view will be cyclical and interest rate sensitive industries with limited pricing power. Heavy industry and basic materials are particularly vulnerable, with chemicals, steel, many of the material subsectors, and traditional energy likely to see intensified pressure on top lines and margins. Real estate, particularly the office sector, as well as parts of the residential sector, are likely to remain under pressure. Consumer discretionary spending is likely to slow, with a number of retail subsectors and big-ticket consumer durables, such as autos, most at risk. However, it's not all bad news. Less cyclical sectors should fare relatively well in our view. Many technology subsectors are well positioned in this environment. Healthcare, while having to contend with continued input cost inflation, should continue to see steady top-line growth. Education, communications, business and financial services, infrastructure, and companies supporting the green energy transition are all areas that should continue to perform well in our view. So what does this mean for private markets? Most private companies enter this more difficult economic environment in strong shape. As many of you know, at ICG we've built a large database of private company fundamentals that allows us to track the health of private companies across countries and sectors in Europe and the US. The database has information on nearly 1,500 private companies and over 14 years of tracking data. As you can see on this slide, on our latest aggregated data, fundamentals, as measured by interest coverage and EBITDA growth, remain strong through 2022. Interest coverage has held at high levels, as healthy EBITDA growth has more than compensated for higher interest rates. Bottom-up data indicates this trend has continued into 2023. So while key metrics at an aggregate level are likely to weaken in the coming quarters, they are coming from a strong starting point. Another key strength of private markets relative to public markets is the skew towards the less vulnerable sectors I mentioned earlier. Their limited exposure to cyclical and interest rate sensitive sectors, and their focus on companies with high free cash flow, strong pricing power, and industries with secular tailwinds. This is evident looking at the long-term EBITDA growth of the private companies tracked by ICG's private company database. As a very simple exercise, we plotted historical Europe private company EBITDA growth back to 2008 against Europe's GDP growth over the same period. We then added in the highest, lowest, and median consensus GDP growth forecasts out to 2024. Two things stand out for me. The first is that while directionally EBITDA growth tracks GDP growth, as one might expect, it also tends to show much less pronounced swings than GDP, reflecting the less cyclical nature of the companies private market investors tend to invest in. The second is that even the current lowest consensus GDP forecast puts the slowdown at around half the magnitude of the 2008 global financial crisis. Therefore, if correct, while companies, private and public, may face a more difficult operating environment in the coming quarters, we think private market investors are particularly well positioned. With stable long-term sources of funding, a rigorous bottom-up approach to investing, and large stores of dry powder, private market investors are able to take a long-term view of a company's fundamentals work with managements through difficult times, and find new opportunities during periods of disruption. This held private markets investors in good stead through the COVID pandemic, and we believe it should do so again as we enter this more challenging economic environment. So thank you very much for listening today, and thank you to the Enterprise Trust team for inviting me to speak. I know you'll find the following presentations extremely interesting as you get a much more sophisticated and nuanced view of exactly how the private markets investment process works from the Enterprise Trust team and our guest speaker, Steve Klinsky. I'll now pass back to Chris.
Thank you. We now want to talk a little bit more about private equity itself. And in that context, there are 4 topics I want to focus on. There is, firstly, the private equity accesses a very different part of the market from public markets. Secondly, strong historical returns. Thirdly, I want to talk about allocations. And finally, a few observations on the investment trust structure itself as a means to access private markets. But first, a little bit of context on the size of public equity versus private equity. The growth of private equity AUM is very well documented. But as a proportion of total equity markets, it remains relatively small. Now, the right balance, of course, will vary depending on geography and sector. But I think it's an important starting point to recognize that despite an annualized growth rate of 15%, private equity represents only about 6% of the total equity market globally. And we do not believe the private equity market is fully mature yet. Now, of course, public equity markets over the last 30 years have changed substantially. Many public markets today, even after adjusting for inflation, have shifted towards larger companies. And it's well known that the number of public companies is shrinking, particularly in the US. At the beginning of 2000, there were approximately 7,800 publicly listed companies in the States, and by the end of 2020, it was just over 4,800. So investing only in public equities, particularly in the US, risks investing increasingly in fewer, larger businesses. Now, digging deeper into size and staying with the US as an example, roughly 87% of US companies generating revenues in excess of $100 million are private. Or another reading of this data, there are nearly 5.5 times more private companies in the US with annual revenues of between $500 million and $1 billion than there are in the public markets. These companies are the generators of growth. They're the real economy, the locally successful businesses that are expanding nationally and internationally. And the increased scale of private markets over the last decade has meant that for some mid-cap companies, they never need to raise public equity. And so private equity structurally and fundamentally invests in a different part of the economy. Now, of course, the ownership model of private equity also varies. A private equity fund might have 10 to 20 investments, so it's quite concentrated. And it's typically focused on cash-generative businesses, generally also on businesses that are less cyclical, as Nick said. And that's really a function of time horizon and the nature of how a leverage buyout works. Within that, managers will typically have access to expertise and capital to support growth initiatives, organic and inorganic. Hence, buy and build strategies or roll-up strategies have been particularly popular and successful within private equity. And it's also an actively engaged ownership model with strong economic alignment between management and the equity. GPs will almost always take a board seat. They have deep networks of talent that they can tap into. And with a 4 or 5 year investment horizon, they can make process and operational changes and improvements to have a medium-term payoff. For a number of companies, particularly those in the mid-market, who due to their size or prominence may not have access to this financial or network capital, this can be a very attractive proposition. And there are a number of reports suggesting that historically, investing in private equity has generated better returns than investing in the public markets across multiple time horizons and multiple geographies. The graphs here show modeled pooled returns in the dark blue compared to public market equivalents as an example. And these trends of growing AUM, the ownership model for portfolio companies, and the strong returns for investors come together, I think, to create quite a powerful dynamic. And one way of looking at this, perhaps, is that private markets have created something of a self-reinforcing ecosystem. And let me explain that a little bit more. We have seen a substantial increase, as we've said, in the amount of AUM focused on private markets. This has enabled more companies to stay private for longer. And they may decide to do this for many reasons. Flexibility of capital, the ability to focus on long term with fewer quarterly distractions, the regulatory obligations of a public listing. And because more companies are staying private for longer, there is a larger addressable market of investment opportunity for private AUM. So there is more money, but at the same time it is chasing a potentially larger investment landscape. And because both sides of the equation are growing, private markets have continued to be able to generate attractive returns at increasing scale. And those returns, in turn, mean that there is increasing client demand for private markets, which helps drive that cycle. In some ways, this is perhaps a function of private markets maturing, but we're not fully there yet, and we see this self-reinforcing cycle as being a potentially powerful driver to come for many years. Now, the rise on private equity AUM has not been driven by all investors equally, and therefore the returns private equity has generated have not been enjoyed by all investors equally. This chart shows some allocations by investor type. The largest investors in the world, endowments, sovereign wealth funds, have the scale, contacts and network to develop traditional drawdown strategies. These require multi-million-dollar tickets. They're called over a number of years. It locks up capital for a decade, potentially, and the investor has no control over liquidity. So ultra-high net worth individuals, large institutions have access to private markets, but the broader population frequently does not. And I would include in that group, although it's not shown on this graph, smaller institutions and endowments who may not be able to run large private equity programs as a traditional LP, but who do not need 100% of their portfolio to be completely liquid either, and who want to access parts of the investment landscape where private equity specializes. And this feels a little bit of a miss. You may have read about some more recent innovations of managers seeking to broaden access to private markets, semi-liquid funds, for example. But one of the original democratizers of private equity, if you like, was arguably listed private equity. The closed-end nature of investment trusts solves a number of issues investors with less capital to deploy often face. It is also well matched to investing in long-duration assets and reinvesting returns to generate those compounding benefits that Jane referred to earlier. From an investor's perspective, liquidity is disconnected from the underlying portfolio. Shares can be bought or sold, and it does not require us as the manager to deploy or liquidate our underlying portfolio. And in addition, for investors to get access, it's the cost of a share. In the case of ICG Enterprise Trust, 10, 11, 12 pounds and trading commissions. And for that, you get access to a ready-made portfolio. There is no J-curve, there's no ramp-up period as there would be if you started a program of investing as an LP in a drawdown fund. So as a vehicle and a structure, it does have many attractions. But that is not to ignore the challenges. The shareholder experience on a day-to-day basis is obviously the share price, not the underlying NAV per share. And while over time we believe there should be a strong relationship between the two, discounts, and in particular volatility of discounts, can be a challenge. Likewise, if an investor does want to deploy a significant amount of capital, it can take some time to get in and to get out. And we're aware of these, as is the board, and later we will touch on certain actions that we've taken to try and address these, and Jane mentioned a couple of them already. But we do think it's important here to take a balanced view of the structure, and there really are, in our view, many positives. So in summary, private equity invests in parts of the economy that are challenging and increasingly difficult to invest in through public markets, one which historically has generated very attractive returns, and one to which, in our view, smaller endowments and institutions are potentially underallocated relative to larger investors. Listed private equity investment trusts, such as ICG Enterprise Trust, can help bridge that gap. With that, I'll hand over to Oliver to talk in more detail about our specific approach to private equity investing. Oliver.
Thanks, Chris. Good afternoon, everyone. It's great to see so many familiar faces here. I'm very excited that Chris and the team organized this Investors Day, which allows us to actually spend some time together to talk more about the ICG Enterprise Trust platform, our team, and our strategy. Many investors who would like to invest in private equity ask me why they should invest via the ICG Enterprise Trust. And my usual quick response is that as an investor in the Enterprise Trust, you benefit from private equity returns, but with lower risk. And our entire investment approach has been designed to provide our investors with superior risk-adjusted returns. And my goal today is to provide you an insight of our investment approach, our strategy, and how we achieve this goal. And so hopefully you'll get a much better feeling how we actually achieve this by getting investment returns, private equity type of returns with much lower risk. As you see here, we think ICG Enterprise Trust is differentiated from our peers in three fundamental areas. And let's start with our platform. As we know, we are managed by ICG plc, a UK alternative asset manager with $80 billion of AUM globally. ICG manages several private market strategies that invest across the capital capital structure and in various asset classes. We invest in private equity, in structured equity, private credit, real estate, and infrastructure. In summary, we're one of the leading global alternative asset managers in Europe. And there are two real tangible benefits of being plugged into ICG. Firstly, breadth and depth of knowledge. This is one of the reasons why I actually joined ICG. Being successful in the investment business is very much driven by insight. And I like to call our unique access to insight the ICG footprint. ICG has hundreds of portfolio companies. You saw Nick talking about the private company index. And so we have hundreds of portfolio companies across its various strategies. And this gives us a huge data set, allowing us to spot macro trends, enhances our insight and knowledge about specific sectors or companies. And lastly, it improves also our due diligence in our third-party private equity fund managers. The depth and breadth of the ICG footprint is an enormous competitive advantage. We're never blind. Within the ICG network, we always have a deeper and broader perspective on the fund managers, the sector, and the businesses. ICG is a really powerful platform to help us build this conviction in our investment case. The other benefit Chris alluded to already is that the ICG platform also gives us great access to ICG funds. ICG has over 20 strategies across geographies and different parts of the capital structure. Investing in ICG funds gives us not only access to top-tier funds, but also gives us preferential access to co-investments and secondaries at lower fee levels. Indeed, if you look at our co-investment rate with ICG is about 1-to-1. This is the highest level of co-investment ratio within all of our managers. And today, ICG managed investments account for about 30% of the portfolio, and we expect this to remain broadly consistent over time. So ICG's platform is a very powerful asset that we leverage for knowledge, as well as for return-enhancing deal flow. I believe this is actually an excellent moment to take a closer look at ICG's flagship strategy, and as a case study, how the ICG Enterprise Trust benefits from ICG's investment capabilities. In a moment, I will pass over to David Lomer. He's the investment committee member and the head of the UK, Nordics, and the Benelux of our ICG Europe flagship fund. But first, let me give you a quick summary of ICGT's relationship with the ICG Europe fund. The ICG Enterprise Trust made actually its first commitment to the ICG Europe strategy in 1989. And here's just a little quick fun fact. In 1989, the Enterprise Trust was actually one of the 7 founding investors in ICG, many years before ICG took over the Enterprise Trust actually in 2016. As Colm likes to say, it's nice to see your kids grow up to do better and bigger things. The ICG Europe investment has been our longest standing fund relationship and one of our most successful investments. Since then, the Enterprise Trust has benefited from excellent returns and exceptional direct investment deal flow from the ICG relationship. And since the move to ICG, as a manager in 2016, the Trust has made 6 primary commitments to ICG's European corporate strategy, the latest being 40 million euros in ICG Europe 8. It made 9 direct investments over the same period. And some examples of you see here on the slide here. As I discussed, Enterprise Trust benefits in particular from the ICG Europe direct investment deal flow. And because of the relentless focus on reducing downside risk and targeting resilient risk-adjusted returns, we really, it's a great fit within our defensive growth strategy. So with that, I'll hand over to David to speak a little more about the strategy.
Great, thank you very much, Oliver. Good afternoon to all of those of you in the room and on the video. Thank you very much indeed for joining us this afternoon. And Oliver, we've very much appreciated our long-standing partnership for over 30 years now. So I wanted to tell you a little bit about the European corporate flagship fund for ICG and what we do. As I say, 30-year track record of partnering together successfully with the Enterprise Trust. The fund has grown over that period from 2.5 billion euros to over 8 billion euros over the last 10 years. So what's behind the growth? The key has been a formula that occupies pretty much a unique space in the market. We focus on highly structured and bespoke investments in strictly proprietary deal situations, always aiming to generate both predictable and attractive risk-adjusted returns. And as Oliver alluded to, really what we like to call structuring for defensive growth. For our business partners, we provide supportive capital with growth, for growth with minimum dilution, minimum cash interest burden, covenant risk, or governance invasion. So in short, we pride ourselves on being cheaper, easier, more flexible, and more predictable partners than a classic private equity alternative, and less threatening and less cash draining than the use of excess leverage as an alternative into the capital structure. So we are incredibly empowering for our partners and completely differentiated in the market. There's not really a single other fund out there that aims to do what ICG has been doing in this core flagship strategy for the last 30 years. For our investors, we deliver a unique combination of downside protection with upside exposure, and crucially delivering that with medium-term duration. That means an ability to generate both attractive IRRs and multiple of monies over time. To give you some sense of that, over the last several vintages, we've averaged circa 20% returns and 2x multiple of money net to our investors. The charts on the right show a very simple illustration of how our capital can really transform management ownership from a minority to a majority control position, whilst also reducing the leverage burden on a business. And this really, aside from the very simple numbers and illustration, it's a formula that is frankly absolutely transformative to management teams. This goes beyond just the economic effects of going from a minority to a majority situation. It's really transformative to their wealth creation, but more importantly, they're transformative to their sense of control and stewardship over their own destiny going forward within their businesses. So a life-changing form of capital intervention for the companies in which we invest. To bring this structured and downside protected strategy to life, I thought I would maybe share a real-world example with Garnica, which was a recent exit of ours. So Garnica is a family-owned Spanish business and a global leader in the plywood industry. We initially partnered with the founder and management team in an off-market transaction. We structured our investment, interestingly, through circa 80% subordinated debt instruments, and the balance was in a minority equity position. Despite very low leverage, roughly 1.5 times senior debt to EBITDA, the subordinated debt was priced at a pretty attractive 14% annual coupon. And our equity investment, and this is a sort of what ICG does best, was really structured with downside protection from the start. It was stapled to our debt and had a contractually agreed minimum IRR of 18%. So structured in this way, our equity investment was in fact no longer really an equity risk profile, but it did benefit from all the equity upside on the security. We exited the company last year. Our equity investment made roughly 3 times our money, and across all our instruments, we realized a 2.3 times multiple. So I wanted to give you this illustration because this is an example of a situation that was well structured and a well-priced investment for us at a prudent leverage level, and it was enormously value creating and empowering for our family partner, a true win-win in the best style of ICG investment. So I hope that gives you a slight flavor of the deals that we do. As you can imagine, in this environment of dislocated capital markets, the opportunities we're seeing to do transactions like this are more numerous and more attractive than ever. So on this next slide, what does the ICG European Corporate Strategy mean for returns? In short, consistency and predictability. So the way to read this chart, the black line shows the normal distribution of our ICG returns, and the green line shows the distribution of average European buyout returns. And what you'll see is that from ICG, we're incredibly tightly clustered in the outcomes that we achieve for our investors. The vast majority of our transactions generate a predictable 1.8 to 2.3 times returns. And it's that predictability and consistency that has been key to our growth and success on the right-hand side of the page. We strongly believe, and we've built our strategy around this, that our investment strategy represents the best balance of risk and reward in the broader private capital markets arena. So on this following slide, you can see how the strategy has evolved over time. From our Fund 5, which was invested with a heavily de-risked mandate targeting 1.5 times and significantly outperformed. Since then, our funds have targeted 1.8 times and have continued to outperform. Fund 6 has delivered a super return for investors, and Fund 7, whilst it's earlier in its journey, is shaping up to be even better. Our latest Fund 8 is off to a great start. It's already very well deployed, and in this environment, we expect it to generate the same very attractive 2 times returns, but structurally with even lower risk exposure through the capital structure. So I hope that's been a helpful insight into ICG's European corporate strategy. As I've said, it really occupies a unique space in the market. There's not another investment fund that aims to do the types of transactions that we do, heavily de-risked within the middle of the capital structure. We're enormously grateful, Oliver, to you and the whole team behind the ICG Enterprise Trust for your long-standing support, both on primary commitments and also on direct investments. And listen, I think in environments and markets such as these, our focus on partnering with strong management teams to empower and share their upside whilst protecting our downside has frankly never been more relevant and aligns perfectly, I think, with the ICG Enterprise Trust focus on delivering defensive growth. So with that, I'll hand back over to you, Oliver, and as I say, many thanks for a great partnership.
Thanks, David. So you've heard now quite a bit about the ICG platform as a key differentiator for the Enterprise Trust. But one of our other key differentiators is we have a dedicated investment team. And I'm particularly proud that we have such high quality investment professionals dedicated to the trust. Unlike many other listed trusts, we have a dedicated team of investment professionals based in London and in New York. And all of my colleagues that you see here on the top of the row of this page are exclusively and 100% working for the Enterprise Trust. So we analyze and make decisions for each investment opportunity on the basis what is best for our vehicle. We're not a feeder fund into someone else's strategy, and we're not obliged to make any investments. So we're completely independent making those decisions. And in the past 4 years, we further enhanced our investment expertise in co-investments and secondary investments by bringing on board Lisa, Ryan, and Vivian in London and Vivian in London. And Lisa Lee has been working with us, worked for 10 years at GIC, one of the largest private equity investors in the world, and where she was responsible for co-investments. And for our secondary investments, we also benefit from the specialist support of Ryan in New York and Vivian in London, who both worked for me for more than 10 years at Pomona Capital. And Pomona, for those who don't know, is one of the pioneers in the secondary market. And with this team, it just really allows us to actively manage our portfolio, to independently select top-tier funds, and proactively identify the best direct investment ideas we can create and source from our fund managers. Now I'd like to kind of finally discuss our investment strategy, which I'm particularly proud of, and since it has given our investors, for many years, very resilient and strongly compounding returns. And this is probably one of the more important slides in the presentation because it's really the beacon to our good returns, in my opinion, and it provides a very clear and proven framework for the investment team. This investment strategy is effectively our recipe for superior risk-adjusted returns. In summary, our goal is to give our investors access to the greatest hits in private equity, as I like to call them, but within a balanced and a very diversified portfolio. And we achieve this balance by firstly building a portfolio of top-tier buyout funds in the US and in Europe. And our goal is to have about 50% of the portfolio exposed to primary commitments, which will give us the opportunity to source and select the best ideas from our fund managers, and our allocation of 25% in direct investments and 25% in secondaries allows us to actively construct a portfolio and to increase our exposure to the best ideas of our fund managers. So that 25% of co-investment and 25% in secondaries is really where we can create alpha as a dedicated investment team. And as you know, risk-adjusted returns and defensive growth are the overarching themes of our investment approach. So this slide really takes it to the next level. So I'm going to spend the next 10 minutes unpacking this slide and putting some data around why we think our investment strategy is such an attractive approach to generate long-term returns. As you know, private equity has its risks, and therefore we have over the years continuously tweaked and refined our investment strategy to really make sure that we can reduce the inherent risk of private equity, but without sacrificing the outsized returns we can generate in private equity. And this slide shows you the different components of our investment strategy. So components A, B, C, and D, buyouts, developed markets, large cap, top tier funds, allow us to take risk out of private equity. And the components D and C, top tier funds and defensive growth, allow us to really generate the outsized returns. And so we believe this unique investment strategy is well suited to a perpetual vehicle like the Enterprise Trust, because it's really focused on generating compounding returns on a multi-year horizon. And let's dig deep into the data now. So next slide. You see here, we're focused on buyouts. The term private equity is a very broad church, as you know, incorporating all kinds of different types of investment styles and approaches within the private markets. And for us, we're very clear that we focus only on buyouts. That means control transactions in mature, profitable, and cash-generative companies. We do not invest in venture capital because venture investing is affiliated with significantly higher investment loss ratios. Loss ratios in venture are on average 60 to 70% of capital, versus in buyouts, the average is around 10 to 15%. So it's a fundamentally different game. And this slide shows the dispersion of the market-wide returns across buyouts, VC, and growth, as well as mezzanine investments. And then the dark blue bars on the left in each chart represent about the 5% of returns, and the gray on the right are the bottom 5%. But more interesting is looking at the middle three bars, the first to third quartiles. And you can see here that buyouts generate an average of 17% IRR and have a much more narrow range of returns than VC and growth. And on the other hand, while mezzanine has an even tighter range, the absolute returns are notably lower. So maybe just a quick note on the downside. So even if you happen to select a poor buyout fund in the 5th percentile, you're still getting a good chunk of your initial money back with a negative of 3% IRR. So we are in an investment vehicle which is focused on generating compounding returns, and therefore minimizing loss ratios is a very important factor in making the model work. And we view this dispersion of returns as an indicator of risk. And in our view, the attractive absolute returns combined with a more narrow range of outcomes, which we'll show you later in a slide, and low loss rates means buyouts provide a very attractive risk-reward profile. Let's discuss returns of buyouts across various geographies, which is the other important component for us to take risk out. The data paints a very clear picture that you want to focus on the US and Europe. They are the most deepest, most sophisticated, and most liquid buyout markets, and the opportunity set is very large. The legal structures are certain. The debt financing markets are broad and sophisticated. And you have currency exposure in dollars, euros, and GP, and in British pound, which is certainly more attractive than some other more exotic currencies. You can see on the slide also that these markets have historically generated strong buyout returns with attractive dispersions and low drawdown risk. And we at ICG Enterprise Trust, with the help of being on the ICG platform, we have significantly increased our exposure to the US, and it's been a strategic objective since we came to ICG. So we target now our portfolio being about 50-50 split between the US and Europe. So now we've narrowed the buyouts within the US and Europe, and the next stage with our funnel is talk about the mid-market and large cap focus. And with limited exposure to, we have some limited exposure to what might be termed mega cap, but our main focus is really on the mid to large cap. What we're certainly are very much focused is to avoid small cap, and which are more akin to VC growth types of investments and volatility. And in practice, these definitions vary between geographies. What is mid cap in the US might be seen as a large cap within the UK, but as you see here on the slide, we used as an indication, we show the returns of funds above 10 billion and on the other side, 750 to 10 billion. To give an indication of how size of a fund and the implication of the size of the underlying investment can impact returns. But I think more interesting for this particular theme of our investment strategy is the intuition which is set out on the right. In short, it's a much larger addressable market, both in terms of the numbers of companies, the number of managers focusing on it, and we just have many more opportunities for private equity owners to drive value creation. And at the back end of an investment that is in an exit, there are many more options if you're in the mid to large sector. So when you look at the mega cap or the very large cap, most of your exit has to be really through an IPO, versus in the large to mid cap, you can have a trade to a buyer, you can sell it to a private equity owner, and you have also the option for an IPO. And you see that within our portfolio that we have relatively few listed exposures. Our focus on mid to large cap was quite well rewarded last year, where we had over 50 exits in our portfolio and over 21% of our portfolio of NAV was realized despite a very challenging market environment. As one of my colleagues at ICG likes to say, the mid-market is where alpha lives. So we very much like to focus on the kind of the mid to large end of the spectrum. So let's refine the scope even further. This is where we generate returns and where we can generate outsized returns by investing with top-tier managers and in their best ideas. For a number of reasons, private markets have a higher dispersion of returns than public markets. And as you can see from this chart, if you had been invested in private markets over the last 10 years, you've been exposed to, and you had been exposed to bottom quartile managers, you would have had a pretty miserable 3% return, way below the lowest quartile of public equity returns. On the other hand, if you had picked the median or the top quartile returns with private markets, you would have outperformed the top quartile of the public markets. So manager selection really matters for private equity. And this is where our brand, the ICG platform, and our network really comes to the fore. We're not constrained by investment or commitment opportunities. We have more opportunities come through on a day-by-day basis than we can commit to. So we are really not in a situation where we are compelled, where we have to deploy capital for fear of sitting on surplus cash. This enables us to be really highly selective and focus on the top-tier fund managers, which have a history typically of delivering strong absolute and relative returns for our shareholders over many periods. Now, the final pillar of our strategy is that we focus on defensive growth. Our defensive growth focus helps us to select fund managers and companies which invest in non-cyclical market-leading companies, and we talked about it, and Colm and the team will talk more about it. Companies who are resilient during the downturn and capture the growth trends. But usually when we speak about defensive growth, we hone in on the company's defensive growth characteristics, so more the qualitative part, more about the sector and the company. And our guest speakers, Steve Klinsky, Colm and Lisa will provide more qualitative data later in the presentation. But today, what I like to focus with this slide is talk more about the quantitative side and why the focus on defensive growth is so powerful. And as Jane mentioned earlier, our investment approach is focused on generating leading and resilient risk-adjusted returns over the long term. And if you've seen through this funnel, our investment strategy seeks to take the risk or volatility out of private equity returns and minimizing downside risk in more challenging times. But at the same time, we like to deliver growth in the good times. Now, why does this really matter? Because as an investor, you want to benefit from the power of compounding returns. And this slide illustrates this power of compounding returns by showing 3 different types of return profiles over 5 years. So as you can see in the sample, simple math example, consistent returns outperform significantly more volatile returns, even if you miss out on some big upsides. And I think the last couple of years really showed us that we were actually quite happy to miss out on some of the big venture returns some of our peers and some of the private equity investors enjoyed of the past years. But we were happy to avoid the high volatility of venture capital investments. And that's just what you see here on the slide. So before pausing for a break, I'm excited to introduce you to one of our North American managers, Steve Klinsky from New Mountain Capital, which is a great case study for our manager selection and including our focus on defensive growth. We first committed to New Mountain in 2017. We have also made a direct investment alongside them, a company called IRI, which continues to be a very good transaction for the ICG Enterprise Trust. And in addition, we've made last year a secondary investment in one of the New Mountain funds, which are very difficult to access in the secondary market. But our relationship with New Mountain, and particularly Colm's strong building that relationship, allowed us to actually purchase a very attractive secondary. We think Steve's views on the U.S. mid-market and the role that private equity can play in supporting businesses is a useful and informative place to kind of end the session. And with that, I'll hand it over to Steve. You go.
Hello, everybody. I'm Steve Klinsky, the founder and CEO of New Mountain Capital. I'm very pleased to be here to speak with you on behalf of ICGT. My own background is I'm one of the longest standing and private equity people in the United States. I was in graduate school for law school and business school when the first leverage buyout of a public company happened in 1979. Wrote my graduating thesis at Harvard about it. Came to New York in 1981 as buyouts were just beginning when interest rates were 15.84% for the 10-year Treasury. Was co-founder of Goldman Sachs' original private equity group, did about $3 billion of transactions there. Was with one of the two biggest firms in the world from 84 to 99, a firm called Forsman Little that was second biggest to KKR but had exceptional returns. And then I broke off to start New Mountain in January of 2000. So we're about 23 or 24 years old now. We've had a great run of it, and we're getting stronger as time goes on. We're really based on two fundamental ideas. One is defensive growth, and the other is business building. And what we mean by that is we choose top down the sectors of the economy that should be able to grow for the next 10 years, whether times are good or bad. So we want to be strong in all economic conditions. So we're in industries like life science supplies, healthcare information technology, digital engineering, managing wind and solar farms, those type of industries. We don't want to worry about the macro economy or oil prices or anything else. We usually buy companies that are about $500 million in size, very conservative on the use of debt. We've never had a bankruptcy. We've never missed an interest payment in the history of the firm. And we buy these nice mid-market companies and try to build them into new mountains in their own industries. So we're now on raising our seventh fund. Our last fully invested fund, which was Fund 5, is over a 30% net IRR. Been top quartile according to Preqin fund after fund. Again, never with a bankruptcy or missed interest payment. We manage about $37 billion in total assets today, and are very pleased to be partners with you all and ICGT. As far as the way we view private equity, we really think of it as business building, not as financial leverage. So, for example, there's a big article in Harvard Business Review last year about a company that we own called Blue Yonder. It started as a little $600 million software company called Red Prairie. We built it up into the world's leading supply chain software company, added artificial intelligence to it years ago, and sold it for $8.5 billion a little bit over a year ago. Similarly, we just sold a company just a few months ago called Signify that we had bought for around 500 or 600, just sold it for $8 billion at the bottom of the stock market. It was 6 times return on a $700 million equity check. So we've now, our last 16 exits for the fund, for Funds 4 and Funds 5, have averaged about a 3.8 gross multiple and about a 39% gross rate of return. And again, not by taking more risk, but by controlling risk and building businesses. And we do try to think, we plan to own a business for, say, 5 years. The new buyer is going to think about the next 5 years. So we try to think in 10-year increments, always trying to steer the firm into the best sectors for the next 10 years. And we've grown from me all alone in a rent office with a metal desk that I paid for by the month. We now have over 220 people at the firm. We employ close to 99,000 people at the companies that we own. We would be roughly 65 in the Fortune 500 if we were one organization that reported that way. But we're still focusing all that strength to buy essentially a mid-market company and build it. And it's a culture where everybody gets equity in every deal from the receptionist on up, where we're all trying to work together in a very flat, intellectually honest way to make good decisions. As far as the opportunities today, we think it's a very good time for our firm. We've returned $15 billion of cash just since January of 21. We've had $10 billion of gains just since January of 21. We're in non-cyclical sectors. The valuations are better than ever as the market is more depressed. We should get better buys as we're buying companies. And we only use about 4 times debt to EBITDA, so we're still able to fully finance our acquisitions and be very proactive on reaching out to the companies that are scared to say they're for sale. We can find them in a private way and negotiate private purchases. So it's actually, if you look just historically for all private equity, the best vintage years for all private equity are after the bad news hits. You get better valuations, and then we think we're particularly well positioned because of our defensive growth, low debt business building approach, and our team gets bigger and stronger. So we've been top quartile every fund according to Preqin since Fund 2, but the returns are actually rising as the team gets stronger and better. So with all that, let me again thank you for the relationship we have with ICGT. We partnered together since 2017. There was an investment by ICG into one of our companies called IRI, that's a leading database company that's been very successful. I think we share a common culture of defensive growth, long-term thinking, trying to build companies in the right way, and we very much look forward to the relationship that we have with you and an ongoing relationship. So thank you very much for letting me address you today.
And with that, we will have a 10-minute break and we'll restart promptly at 20 to 4.
Okay, well, welcome back. And it's good to see so many of you braving the heat to be here in person, as well as those joining us online. For those of you who don't know me, my name is Colin Walsh. I'm Managing Director and Portfolio Manager of ICG Enterprise Trust. And I've helped to manage ICG Enterprise since the end of the global financial crisis. That was 2010. So I'm now into my 14th year. So over the next few minutes, myself and Lisa will spend some time digging a bit deeper into how we construct our portfolio. So Oliver has already covered our investment strategy. And as a quick sort of post-break reminder, we focus on buyouts of mid-market and larger companies within North America and Europe. And hopefully Steve Klinsky's commentary brought that to life. And thank you, Steve, as well, for covering defensive growth so eloquently. This slide shows the results of that strategy. Geographically, we are now evenly balanced between North America and Europe. 7 years ago, when we joined ICG, we were almost entirely European focused. The US strategy increased the depth of the market opportunity, and we've been very successful accessing some of the best managers, such as New Mountain, who we just heard from. In terms of size, we're focused on the mid-market. 85% of the funds we've committed to are less than 10 billion, and the majority of our investments have enterprise values less than 1 billion. That's roughly the entry level of the FTSE 250, and much smaller than a FTSE 100 company, as Chris noted earlier. Many of these companies are choosing to stay private for longer. This is a distinctive portfolio within the listed private equity investment trust space, and we believe it's well placed in the current environment. As Oliver outlined, we constructed this portfolio through a combination of primary, direct, and secondary investments. If you like, the building blocks of our portfolio, with different but complementary return characteristics. Over the medium term, we target around 50% of the portfolio to be primary investments, with direct and secondaries being around 25% each. These 3 building blocks are highly complementary in a number of ways. Firstly, primary commitments. They're a way for us to get diversification of underlying portfolio companies, to manage our geographical exposures, and to deliver strong risk-adjusted returns alongside leading top-tier managers. They're also the sole source of deal flow for our direct investment program. So the focus on manager quality directly feeds into the directs program. These investments, we typically invest on a fee-free basis in companies alongside our existing managers, enable us to increase the portfolio's exposure to specific businesses, which we believe are particularly well aligned to our defensive growth focus. They're a source of alpha, and they reduce the overall fee load. Of course, there is more risk here. In a typical primary commitment, we might end up with exposure to 10 to 20 underlying companies through the life of a fund. whereas direct investment is, of course, a single asset risk. So sizing, conviction, manager quality are very important here to balance risk and reward. And finally, secondaries, where we've increased our exposure over the last 18 months, utilising the expertise which Oliver and our other experienced secondary colleagues bring to this space. In a secondary purchase, we're buying typically a series of older commitments to funds from other investors. So typically, it's a larger ticket size, buying a diversified pool of investments with very limited blind pool risk. Or in more simple terms, we know the underlying companies we're investing in, we can form a view on their future prospects and price accordingly. And because we're buying mature portfolios, the cash return is frequently quite quick, with a shorter payback period than for either primaries or directs. Now that's clearly very good from an IRR perspective, but it also helps our liquidity management. And putting those three routes to market together, we believe that you have an attractive way to access the PE market, and one which also allows for efficient liquidity management. The flexibility of the approach also allows us to adjust composition between the deal types depending on prevailing market conditions. Now, having seen the theory, here we show how it works in practice. So this chart shows our absolute 1, 3, 5, and 10-year portfolio returns, split by primary, direct, and secondary investment types. Now, as you can see, direct and secondary investments outperform primaries in absolute terms. But remember, primaries are more diversified. They therefore come with lower risk. So we like to think of our returns holistically. Remember, the quality of our direct portfolio relies on our primary managers. And you can see on the far right of this slide, the combined performance. Strong double-digit returns for the 3, 5, and 10-year periods, generated from a portfolio which is appropriately diversified. It's a portfolio that is better performing than a primary-only investment program, but more consistent than a portfolio exclusively made up of direct or secondary investments. Now, we're now going to spend some time doing a deep dive into each of these, as I say, building blocks, starting with primaries. So we have around 35 active relationships with managers today, and they're almost evenly split between those based in Europe and those based in the US. We believe that this is a really good mix. So what you see is some brand names, some names you may have heard of, as well as some other managers that fly under the radar, but who have a very strong track record. Many of these relationships are long-term partnerships. So you've heard earlier on about ICG itself, but also managers like PAI. And we're constantly meeting, tracking, and assessing new managers. But we're also cautious about having too many. We want to be relevant to our managers. We want to be there to support them when they offer us attractive co-investments. These relationships are very much partnerships. We're an attractive source of capital. We have an ability to continue to support our managers because of our evergreen investment trust structure. And that gives us the ability to access often oversubscribed funds and invest directly alongside these managers. Now, you've already heard from Steve Klinsky about New Mountain Capital, but I wanted to take a look at another one of those partnerships just to put it all into context, and that's Gridiron Capital. So Gridiron was one of our first US partnerships, and it's been an extremely successful one, given the strong performance of its funds and our direct investments alongside them. So I helped to start our US investment program back in 2016. One of the first things I realized, and I think Oliver has discussed this at length when we talked about the ICG footprint, was the benefit of the strong institutional relationships with our New York office. So our investment in Gridiron started with an introduction from ICG's senior debt team in New York. So this is a team that knew the key people, they'd worked with them on deals, and that gave us a very differentiated insight. That's a key benefit of the ICG platform, and it helps us to make better and more informed decisions. So Gridiron is very different to that typical stereotype that many people have about private equity managers, the sort of aggressive Gordon Gekko style corporate raiders. They're based in a small town in Connecticut. The firm has a very distinctive culture. It's rooted in partnership, teamwork, and building businesses. And hopefully you can see quite a degree of commonality with what Steve Klinsky just talked about. So we're fundamentally backing people, and we believe that the culture and integrity of those people are critical. The Gridiron motto is about winning together. There's a strong operational focus to adding value. It's very much about working with companies to improve them and to grow them. And Gridiron's become a very valued investment partner. We currently have, as you can see on the slide, 3 direct investments, total equity of over £24 million. And one of the things we also discovered is that when we do the detailed diligence on the companies, it helps to reinforce and to affirm our faith in the manager. And as a result, we were very happy to grow our commitment to Gridiron's 5th fund in 2023, committing $20 million. That's our 3rd fund investment alongside them. It's a very good example of our approach to growing primary relationships. So now Lisa is going to take you through our direct and secondary programs, hopefully allowing you to see how this all fits together. Lisa.
Thank you, Colin. Turning to our direct programme. Firstly, I want to emphasise the importance of our primary commitments in sourcing direct investments. As you can see here, we've been successful in accessing such opportunities from our third-party managers. It is worth highlighting, though, that the managers who we've done the most direct investments with are generally those with whom we have the longest relationships. Therefore, as relationships mature, we would expect this list to grow. Within our direct investment programme, we are highly selective, having invested in fewer than 1 in 5 of the opportunities we originated over the last 6 years. Unsurprisingly, direct investments alongside ICG managed funds have the highest conversion rate. Firstly, the profile of businesses targeted by other ICG strategies is often aligned with ICG Enterprise Trust's focus on defensive growth. Secondly, we have far greater access to the deal team to help build conviction around the opportunity, all of which explains why historically we've executed on about 90% of the direct opportunities offered by ICG. Opportunities from our third-party managers have a significantly lower conversion rate of 20%. No one expects us to say yes to everything, so in situations where we do decline, we do so quickly to avoid wasting anyone's time, and we are transparent about the reasons. The flip side is that if an opportunity is a good fit for us, we will run hard at it and can work to a tight timeline. Overall, this helps us to build trust with our managers and strengthens our relationships with them. And finally, it's worth noting the very low conversion rate for direct investment opportunities we receive from managers with whom we do not have a primary relationship. This stands to reason. Generally, a manager will offer direct investments to its own LPs first, and will only open it up to external investors if there isn't sufficient take-up. Almost by definition, these opportunities may be difficult to underwrite, for example, due to deal complexity, cyclical exposure, or a very high valuation. And this low conversion rate reiterates how important it is to have a broad pool of primary relationships with high-quality managers who offer us attractive, executable, direct investment deal flow. Since moving to ICG, we have dramatically increased the scale of our direct investment programme, doubling the average number of investments per year and increasing the average amount of capital deployed into direct investments by 3.5 times. This is partly driven by the underlying growth of ICG Enterprise Trust. In other words, we need to invest more to keep our portfolio construction in line with our strategy. But more importantly, it has been a conscious decision to pivot the portfolio towards a higher percentage of direct investment. This is consistent with our active portfolio management approach, where we look to build more concentrated exposures to specific companies which resonate particularly well with our investment strategy. And of course, as we typically do not pay fees to third-party managers for direct investments, it also reduces the fee burden for our shareholders. European Camping Group is a great example of what we look for in a direct investment. Firstly, it's alongside a leading manager, PAI, who have both industry and geographical expertise. We've known PAI since 2005. The company is a market leader, offering premium campsites predominantly in France. Some of those logos may be familiar, as one of the core markets is the UK. As a relatively affordable, high-quality offering, ECG has demonstrated resilient growth and has historically been relatively defensive. There are multiple levers for growth, in particular M&A, as the market is highly fragmented and benefits from economies of scale. This is also a great example of the ICG platform advantage. As previous investors in a very similar UK group, and given our long-established presence in France, we were able to draw on the significant internal knowledge about the industry and deal dynamics. We are looking forward to seeing the company continue on its growth trajectory. Turning now to our final route to market, secondaries. Since 2020, we've been focusing on increasing our exposure to LP secondaries, which has been a very notable success. We've completed 5 transactions, committing a total of £98 million to a portfolio of over 100 funds managed by over 60 different managers. Geographically, our secondaries exposure mirrors our target for the portfolio as a whole, broadly balanced between US and Europe. The sector exposure is also diversified, with a strong bias towards the defensive growth sectors we discussed earlier. Economically, despite it being early days, the LP secondaries portfolio has already generated significant value for our shareholders. The multiple of investor capital currently stands at 1.5 times, and importantly, the DPI stands at 0.3 times. DPI, as you'll know, is a measure of how much of your original cash investment has been returned. That is, your realised proceeds. So, 0.3 times means that already, in less than 3 years, roughly 30% of our initial cash investment has been returned, helping to underpin our returns and underline the strong cash distribution profile of LP secondary investments. I would now like to provide a brief overview of our first LP secondaries investment back in Q2 2021, ICG Ludgate Hill 1. This deal, in many ways, encapsulates our approach to LP secondaries. It comprises a highly diversified, mature portfolio of 92 funds managed by leading top quartile GPs. We were uniquely positioned to win the deal, given our historical relationship with the seller and our dedicated LP secondaries team, who were able to spend the time to assess the portfolio on a detailed bottoms-up basis whilst leveraging our primary relationships. Ultimately, this meant we saw value in the portfolio when others didn't, and were able to negotiate an attractive entry price. The investment is performing very well and is currently marked at a 1.8 times MOC, over 70% IRR, and perhaps most importantly, has generated a 0.8 times DPI. This means that 80% of our cash investment has already been returned. And with that, I'll turn back to Colin.
Okay. So our ambition is hopefully, after all of this, clear, to generate attractive long-term returns for our shareholders. And we aim to do this through a targeted investment strategy with a flexible mandate, enabling us to invest in private companies, as we said, through primaries, direct investments, and secondary portfolios. All well and good, but does it actually work? So this pyramid illustrates how we evaluate whether the approach works. And at the top, you can see our shareholder returns, the core basis on which we aim to deliver. But that outcome is built on a foundation of investing in companies that perform well, that should generate attractive portfolio returns and in turn lead to attractive NAV per share total returns. And at each stage, there are, of course, other factors that need to be assessed. So we look at currency, we look at fee load, we look at sales and marketing, the form of shareholder returns. But most of our return should, and historically has, come from the performance of the underlying portfolio companies. So here we have a record of which we are exceptionally proud. So since 2010, the top 30 companies in our portfolio have generated positive year-on-year EBITDA growth, as well as strong absolute levels of growth. This has averaged 15% per annum compared to 4% for the FTSE All-Share. So what does this tell us? Well, firstly, it underlines that our portfolio, as my colleagues have outlined, it's exposed to a markedly different part of the economy compared to this index and most other public market indices. We're investing in companies which are typically more stable, less volatile, and with higher levels of underlying growth. And they are also, as we saw earlier, much smaller companies, and they're weighted towards attractive subsectors. This pattern reflects our defensive growth approach. So volatile earnings may give some very good years, but also some pretty challenging years. And the maths around compounding, which we've outlined, means that consistent growth is far more valuable in the long run, as opposed to having big ups followed by big downs. So the strap line here, consistent growth and lower volatility, sums our approach up pretty well. And that also feeds through to underlying portfolio performance. So that portfolio company performance has enabled us to deliver our 14th consecutive year of double-digit portfolio growth on a local currency basis. The portfolio returns over various time horizons reflect the earnings growth of our top 30 companies, which you've just seen. And it's the core source of portfolio growth across the portfolio. Another source of growth are uplifts and exit, which also help to validate unrealized portfolio valuations. And as you can see from this slide, there's a long-standing and above all consistent track record of meaningful uplifts on exit, as well as strong money multiple returns when things are realized. And as I said, it's a consistent track record, with uplifts being in the range of 20 to 40% across a meaningful portion of our portfolio. So even the last financial year, FY23, with more subdued realization activity across the wider market, we had full exits of 11% of our portfolio at a weighted average uplift of 24%. Now that gives us confidence in our managers' NAVs, and we believe should help shareholders build trust in the integrity of the valuations. Remember, our managers have no financial incentive to inflate valuations. They don't directly benefit from higher unrealized returns. And there's only reputational downside risk if you say mark something at 3 times cost and then you realize it at 2.5 times cost. Much better to mark it at 2 and realize it at 2.5. There's definitely a stigma to marking something down on a realization. So we have a high quality portfolio underpinned by strong historical earnings growth, and it's generated strong returns. And these returns, critically, are generated with low dispersion. Again, it's that strapline, consistent growth, lower volatility. So this chart shows the pattern of both unrealized and realized returns at the underlying company level. And it's weighted by our invested cost. So a few things to note. Firstly, there's a very tight dispersion, the consistency of returns. So 3/4 of our total returns, you can see in dark blue, are between 1 and 3 times multiple of cost. And they're broadly evenly distributed above and below that figure. But the realized returns in light blue are much more positively skewed. So 60% between 1 and 3 times, but roughly 30% greater than 3 times cost. And that makes sense. The difference between the two bars is, of course, the unrealized returns. And you would expect these to have lower multiples. They are on average less mature deals, and a large part of that portfolio represents new deals marked at or near cost. And as a result, our NAV per share total returns have also been impressive and consistent. And as we've become more fully invested since we joined ICG, the gap between our portfolio return and our NAV per share total return has closed. And that's the ultimate output of the approach we've outlined today, boosted by the ICG platform, boosted by the quality of the managers we commit to, as well as our focused strategy. It's a track record of which we are very proud. The benefits of the shifts in investment strategy made since joining ICG, the US program, the secondary strategy, they're becoming increasingly clear. And we're very excited for what our portfolio will deliver in the future. So with that, I'm now going to hand back to Oliver, who's going to link our NAV performance to the shareholder experience before we conclude and open up the floor to questions. Thank you very much.
Thanks, Colin. So you're only a couple slides away from conclusion here, so bear with us. So I want to pause for a moment on the mechanisms of shareholder returns. While the NAV per share total return, which Colin discussed, is in the long term the key driver of our returns, but the form of return matters as well. So capital versus income. And over the last few years, with the help of the board, we have refined our shareholder returns to give more confidence around the income stream through our progressive dividend policy. But at the same time, from a capital allocation perspective, we started in October last year a long-term share buyback program. The purpose of the share buyback program is multifaceted. Clearly, buying at a discount to NAV is accretive on a per share basis, but we're also using it to support liquidity and avoid the air gaps we talked about in our share price during a day when there is a seller without a buyer. The time will tell how successful this is, but early indications look supportive, and the board reviews this on a quarterly basis. We do expect, however, capital appreciation to be the main source of shareholder value over the long term, consistent with our underlying investments. And this table here illustrates how much of NAV growth over the last 5 years we have monetized through shareholders, for shareholders through dividends or buybacks, and compared to how much we have actually reinvested. And of course, in practice, a lot of the NAV growth was unrealized, so it could not be fully returned to shareholders. But what it does indicate is that the dividend takes priority in years where NAV growth has been lower and the dividend has continued to grow, and the amount of reinvestment was therefore been lower. And this reinvestment is being made into a vehicle with historical strong returns, and the compounding nature of that reinvestment profile is, to my mind, a powerful driver of shareholder value over the long term. However, the shareholder experience is not just the NAV per share, and we're acutely aware of this, as you see here on the slide. And so before closing, I want to make sure we consider our share price and not just look at the NAV and the total return. And you see on this chart how our NAV per share since 2005 has demonstrated materially lower volatility than our share price. And then indeed, in previous periods, when the discount has widened dramatically, usually the share price increases to close the gap rather than the NAV declining to close the discount. So we're hopeful that we'll continue to see this trend. And we strongly believe that investor awareness and understanding will be a benefit across for the enterprise trust, but also for the listed private equity sector. And we view this as central to close the discount to NAV and to democratize private equity for a wider range of investors. Now, turning over, I'd like to highlight some of our initiatives in this regard. Firstly, our disclosure has been significantly enhanced, and in the appendix of this presentation, you will find operating financial metrics for 75% of our underlying portfolio value versus before we showed it for the top 30, in which we disclosed for the first time in the full year results, which hopefully gives you an even deeper understanding of our portfolio companies. Secondly, awareness and education. We have in recent years spent more time and capital increasing the awareness of ICGT in the sector more broadly. And finally, shareholder returns. A progressive dividend policy since 2016 give holders a growing income stream. A long-term buyback program implemented in October 2022, where we have been active in the market to help reduce volatility and enhance liquidity, and a new management fee cap and cost-sharing agreement to ensure that shareholders benefit economically as we grow in the vehicle size. Many of these initiatives will take some time to demonstrate clear economic value, but we believe today we have a very compelling shareholder proposition, and we have advanced significantly on this front. And so we hopefully see this shareholder. You will see this shareholder proposition founded in our portfolio performance, and with very clear actions to help to support the shorter-term shareholder experience. Now, I would like to conclude with our key messages today. I hope this session has reinforced your belief in the long-term opportunity in the ICG Enterprise Trust it can offer as a distinctive and attractive vehicle for investors to access a very specific and, in our view, a very valuable part of the private equity market. A part of the market that seeks to deliver long-term defensive growth with a dedicated team and a clear investment strategy, a portfolio composition and capital allocation policy, all aligned and pulling in the same singular direction of delivering attractive compounding returns. We have a track record that we're very proud of, and we constructed a very attractive portfolio, which is showing resilience during a period of macroeconomic uncertainty. And we're confident that this portfolio of market-leading companies will continue to capture and benefit from the future growth trends. And with that, I'd like to conclude and thank you very much for your time and interest today. I know it's been a lot to take in, but hopefully you have found it useful and additive to your understanding of how we operate, what we do, and how we differentiate ourselves within the investment trust world. So once again, big thank you for your trust and support. And with that, Chris, I'll hand it over to you for Q&A.
Thank you very much indeed. And I will leave those on screen with those key messages. I think they're really important to sum up what we've been trying to communicate over the last 2 hours. So for those online, thank you very much for your time, for your questions, and for joining us. For those in the room, likewise, and we'd love for you to join us for a quick drink outside afterwards in the sun. Thank you very much indeed.